Good morning, everybody. It is Wednesday, November 13th. And just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Uh, we'll start off going through a review of yesterday, but I do want to know, how prepared are you normally for CPI or for big data? And have you ever traded data with a full plan, or do you just jump in on the momentum only to end up getting tossed around? So let's take a look at what we can expect out of today and give you a full plan to get prepared. Yesterday's price action, so we opened inside of Monday's range and Monday's value. And as expected, we saw a decline as insurance was bought ahead of CPI, right down to our 59.88 level that we had given out. And we had mentioned that that's where the insurance providers would then push the market back up to basically collect some of those premiums early. And we saw that work out just as expected, because again, the stock market is a business. And if you understand how a business is run, then you can understand a little bit more about how the market is going to move, who's going to be in the market, and why they're going to be in the market. Tesla did make its move down to our 326 level as we had laid out on Monday, and then it moved back higher. And that was the exact same time the market had bottomed and then started its move up again as well. So we had given out 348 as the big area to watch to the upside and 328 on the downside. And if you know how to use those in your trading, then you were able to capitalize very well on yesterday. In our overnight auction, we have had a smaller range and rotational ahead of CPI. All the transaction has been below yesterday's point of control, which tells us that the agenda is still to hold this market down. From a longer term positioning standpoint, commercials are still short, which we don't get an update on that until Friday after the close. Short term, market makers are in compression mode, which is usually where they tend to want to be ahead of data and major catalysts and events, because they're able to protect themselves better and they don't have really as much risk on. So nothing really changes for them unless we break 59.29 today, or if we get up to 6,089. Longs from last week are mostly in profit outside of Friday. So yesterday we tested settlement from Monday and flushed out a little Friday. And so any longs from there would be taking some heat as we expected. But if you were long anytime earlier in the week, you would be in the money. Shorts from basically since Friday are in the money. But they would be subject to margin calls if we get over 60/40. From a flow standpoint, again, commercials are short, and we'll see if that when that changes on Friday. But we do have a $4.5 billion bid in the market today, as long as we stay between 59.70 and 60.60. At the same time, anybody short from Friday, so we can see a bid in the market from one participant up to 60.60. Anybody short since Friday, if we get over 60.36 and 60.40, we'll have another buyer coming in the market. And that could continue to put upward pressure. Around 60.84, we have a $7 billion bid sitting in the market, or offer sitting in the market. And that would shift our bid from a $4 billion bid to a $3 billion sell as well. So that's about an $11 billion swing in the market. And we really want to pay attention to that today. Short-term fund managers, based on their positioning, they're not expecting much of a response from CPI, which could end up catching them off guard. Some of the breadcrumbs that we have that we want to pay attention to is that volume for 6 out of the last 7 days on this move up has been decreasing. Yesterday, we saw a 31.5% increase in volume. That sounds a lot more impressive than it really is, as that just puts us back into our average volume, but it is something we want to pay attention to, and we'll cover that in just a minute. The insurance in the market ahead of CPI is underinsured by about 15%. So again, while the sky is clear, we know that there's a storm potentially developing right off the coast, and the chosen route this time is much different than any time previously. Every major event in the last 6 to 9 months has been overinsured by about 50% or more, which always leads to support coming back in the market as people have to get out of that insurance premium. We don't have that today, which does leave a slight tail risk to the downside. Now, if you think of a storm hitting a city, If everyone has insurance or has multiple insurance policies, then even if Noah's flood hits, there would still be capital flowing in to rebuild. There's really no risk then to the city. But if only a few people are insured or not, or people are insured but not enough, then if that same storm hits, the rebuild doesn't have the same capital and the same quick bounce back that it would in other environments. So today, fund managers are positioned more as if this is a casino, betting on whether the storm will hit or not, instead of preparing on that tail risk of a downside move. They're leaving that actually open this time. So first, we discussed looking at that higher volume, and in terms of what to expect out of these breadcrumbs, that can tell us that we either are looking for larger support to come in the market today, as volume will increase after the data, and we saw the increase in volume yesterday, or this would be the first time supply is entering the market, and that could lead to a little further downside. And again, we have the levels to pay attention to there, all the way down to 59.29, just in case. For our biggest levels on CPI, there's four of them. So 60.34, as that will trigger many participants from speculators, fund managers, and short-term commercials to change their positioning. 6,009 will put us back into rotational for the week, looking for that 60.36 and 60.40 area. 59.79 is our biggest bid from weekly market makers, with about $1.5 billion sitting there. They can let that flush below before RTH, but that will become a significant level for the commercial side of the market today once 9:30 hits. 59.49, if we do see a move down to that 59.54, 59.49 area, market makers will begin to step in to protect, as there are lots of reasons to protect that area. So what trades are we planning for, and what price action are we looking for is if the initial response on CPI comes into the downside, then we'll watch 59.79 for that first support, or 59.49 area is where we'd see more aggression. If we do get a downside move and we can get an entry at 59.88, then we'll take that to the downside. But on data, sometimes that's too quick to transact. If the initial response on CPI is to the upside, then I will cautiously watch 60.36. That's why I've got this yellow arrow here. This will be the area that I watch closely for a very clear picture of what direction the market is going to take. If we stay underneath that, then we're looking at a mean reverting market. And if we get over that, we're looking for a directional day. If we do get over 60.36, the biggest levels I'll watch will be 60.64 and 60.84. Otherwise, I'm really looking for the market to find balance between 59.49 and 59.97, or 59.97 and 60.40, that 36.40 area. And those two would signal that the repositioning battle will continue, as we still have PPI coming up tomorrow is a big data point, and then Friday is OPEX. So remember, if you haven't ever traded any of these days or these kind of catalysts before, they do matter from a business standpoint. So stay safe out there trading, and have a great day.